Either you work for a financial institution, a microfinance, or a SACCO, and you've been advancing members some loans. Or if you're not working in that sector, you have also yourself borrowed some loan. It doesn't really matter what type of loan it is. Some of them you do on mobile platforms, which is okay. And at one point, you ask for your loan statement so that you get to see how much you are given and how much you've been able to pay or how much you're required to pay back. That loan statement you normally get, whether you give people or you inquire for your loan status, that loan statement contains the details that we're about to look at here. The details that come in the amortization. So I would want us to remind ourselves of those concepts as we look at this question, and I would read it. Joanne Akinyi is a financial analyst who has approached you to analyze a client's loan structure with the following information. Initial loan amount, that is number one, is 5.7 million. The rate of interest is 12.5% per annum. The period is 10 years, payable monthly in arrears. Additional information. The first one, an additional amount of 550,000 is repaid with the 20th installment, and the monthly installment computed to fully pay the loan balance in the initially agreed period. Members, as we read this question, I would want you to look at the language the examiner is using. The language is very important, and the examiner is bringing this simple concept. They know you already have an idea on how to amortize the loan. So that's why they're trying to bring in some twists that if you're not careful and you get it wrong, your schedule might not really balance out as it should. Additional information number two, the rate of interest is adjusted to 13.8% per annum with effect from the end of the fourth year. Number three, the monthly repayment is recomputed to fully pay the loan balance in 12 months less than the initially agreed period. Look at the twists there, members. Number four, the borrower enhances his monthly repayments by how much? 18,000 per month. From what period? From the end of the 64th month. Right? The fifth additional information, the borrower is advanced an additional 700,000. At what point? At the end of the 70th month. And then you are being told again, the monthly repayment is again to be recomputed to fully pay the loan balance. In what period? In the period that had initially been agreed upon. So what period was initially agreed upon? So members, you can see we are used to the plain loan amortization schedule where you just put in your installment that remains constant throughout the period or the repayment period. You have one interest rate that do not change. It is constant until you fully repay back the loan. The period of repaying the loan also, in most cases, has always remained constant. But in this one here, we have all those constants we are used to are now variable, they change. So that is the concept I would want us to look at here. Now, members, it does not change. It is the usual information you already have. We just want to follow through and get to see the slight change in this question. I believe up to this point in time, you're already aware and you've interacted with certain terms when you talk about loan amortization. Whenever you're being told, and I want to borrow from this information number 3 from the start, where we were given the period. And in the period, we were told It is 10 years and the loan is repaid back in what intervals? It is at the end of every month. And I want you to look at that term given in arrears. In arrears. At some point, you might get an examiner talking about in advance. But in most cases, loans are repaid back at the end of a certain interval. When I talk about interval, members, I believe these terms are not new to you. Annually, we talk about monthly, we talk about semi-annually, we also talk about quarterly. I believe these terms are not new to you, members, and I just want you to make sure you note them and remind yourself and know what does the intervals mean and what role do they play in your computation. And I referred to to this note 3 or information number 3 because it directly influences the period. But again, I want you to know the impact it will have on the rate of interest. Remember, the rate of interest is given here is per annum. And here the period is given that these repayments you will be doing is on a monthly basis. Members, just someone to remind us, because just to confirm that we remember and have these tips at our fingertips, somebody just remind us, when you talk about annually, monthly, semi-annually, and quarterly, I just want somebody to give, to remind us of all the three and the impact it will have. So on the interval, that is the period, and on the rate. First, then we see and we remind ourselves on how to handle it. Who is ready? Who is ready to remind us? We are reminding ourselves because we already know it is not a new concept. Somebody who is ready. Unmute yourself and speak. Unmute yourself and speak. Somebody who is ready. Somebody. No one is speaking. No one is speaking.
Madam, pardon your question.
The question is very simple. Remind us that what do annually mean? How does annually affect period and rate of interest? How do you handle it? And how do you handle monthly repayment with the rate of interest and the period of repayment? How do you handle semi-annually in case those terms are given? In our question here, the term which is given is monthly. Monthly. That is the interval. So when you are told about semi-annually, what will change in your computation? When you are given quarterly as the interval of payment, what impact will it have on your computation? How will you apply it? I know it will be easier to do it, practically, but you should be able to put some words to it, members. You can even use our example.
Malemo, let me try. In this example,
yes,
the rate of interest is 12% per annum, and the period is 10 years payable monthly in arrears. So we'll take this rate of 12%, 12.5, we divide by 12 months, because in a year we have 12 months, and this period, this repayment is being done per month, which means in a year it will be done 12 times, but we've been given rate of once a year. So what we'll do, we'll take that rate of 12.5%, we divide by 12 to get the rate per month. Thank you.
All right, thank you, Winnie. We agree with Winnie or we have a different opinion, members? I hope you've heard what Winnie has said. I'm looking at the chat box and I see Elo is giving us a very nice description there by saying the rate is divided by the interval and the period multiplied by the interval. Very simple and straightforward. Thank you. Steve O is talking about annually for the period times 12 and for the rate divided by 12. Thank you. Frida, rate divided by 12 and period multiplied by 12. Members, I believe that makes it so simple, and that's what I was asking. Very simple. We just know that when you talk about the interval of payment, annually, monthly, semi-annually, quarterly, what you need to just remember, if you're given the rate of interest, divide it by whatever interval they're using to pay, or, the period, what period they're using. If it's annually, you divide the rate. If it is monthly, you just ask yourself, how many months do we have in a year? Semi-annually, you ask yourself, in 1 year. Semi means 2, so the payments are done 2 times in a year. Quarterly means how many quarters do we have in a year? So, members, I believe we can relate to those terms. I would want us to start working on this question. Now that we've heard from the good members that they've reminded us, and I believe we understand. Now, members, to start off this question, it is very simple. The loan amortization schedule, I believe you've done it before, and I want to start straight away by laying ground. Maybe I could even start from here, below it, or this other side. Let me just do it this other side. It's okay. The loan amount has been given there, and the loan amount that has been given there is 5.7 million. So 5,700,000, like that. Then the examiner has also given us the rate of interest, and we must work with like terms, members. That is one thing that I would want you to note, that whenever you're working on such type of questions, make sure you work with like terms. What do I mean by like terms? If the rate has been given annually, but if you look at the period or the interval, the repayments are being done monthly. Now, you cannot purport to work with the rate and retain it in form of per annum when you are doing your payments every month. You would want to know what is the monthly rate so that you compute the amount you're paying back at the end of every month. Payment in arrears mean at the end of the period. Payment in advance mean from the beginning of the period. Now, because we've already agreed that the rate of interest given is per annum and we have to convert it, looking at what the good members there have contributed there, and I believe we've understood, now we get the monthly interest rate, because we are repaying at the end of every month, and we need to know the monthly rate. So if per annum rate is 12.5, I will come here and put an equal sign. If per month rate is 12.5%, per year, per annum rate, and we know the number of months in a year are 12. So what do? We divide the rate by 12, and we get the monthly rate. And the monthly rate that we have there has so many decimal places, and we can reduce the number of decimal places. We can reduce the number of decimal places like that, and we have our monthly rate. We have our monthly rate like that. Then we look at the period. We look at the period, and the period that we have, is 10 years payable monthly. So we look at the period, and we know that because we are working with like terms, if it is 10 years period and we are repaying in number of months, now we ask ourselves, in how many months are we supposed to repay back this loan? In how many months are we supposed to repay back the loan? So we know again that 12 months make up a year. 12 months make up a year. And Eileen is asking that I maximize my screen. Eileen, that is okay, and I'm doing just that. So I believe Eileen and any other person who was training, you can now easily see my screen. All right. We are looking at the period that we take to repay back this loan. And like we said, when you talk about the rate and the interval, you divide by 12 because of the 12 months that make up a year when you're given the annual rate. When we come to the period, we multiply. Now, the interval of payment is monthly. We ask ourselves how many months make up a year, and we've all agreed that it's 12. So if the period is 10 years, so we look at the number of months in 10 years. And in 10 years, if each year has 12, then we multiply 10 by 12, and members, we have 120 months. that we need to take to repay back this loan. All right, so now the reason why I've converted the rate of interest to the per month rate, and the period also, we have to check it in the per month format, is because we need like terms. We need like terms so that we be able to get to know how much are we paying in a month given those information. So straight away, we know the format of a loan amortization schedule. An exam setup, we already know, and I've told you that examiners are interested in the number of entries you make. Maximize them as much as you can. Do not waste time. Whatever question that you get, even if it is an AFR question, in fact, please start by drawing the format. Make the entry as many as you can, because that's where your scores will come from. Very fast, we draw up the format of an amortization schedule. And as usual, we start with the period. After the period, we normally come to the balance that we are bringing down. I know someone is already wondering, after the balance brought down, and this question now is talking about changes. The period changes, the rate of interest will change, the amount that we are going to repay obviously will change. Once you change the period and the rate of interest, obviously the amount that you are repaying will have to change. Someone is also, I believe you've also noted that this person, as much as this person is repaying back the loan, but at some point, this person is given more loan. You enhance, or maybe you get an additional loan. And again, at some point, if you get some good money, this person also pays back more than the usual installments. So those variations, we are going to look at them at each stage as we've been given in the additional information. Now, after balance brought down, because of the structure of the question that we have, make sure you put or include the column for additional loan. Remember, I read about an additional loan somewhere, and I believe you noted it. All right. What somebody saying in the chat box, additions. Thank you, Elu. We go to the next item. Now that's when we come to, after you consider the additions, now you ask yourself, what loan amount will open every period? What loan amount will open every period? That's important. Then we go to the usual elements. Of course, you have to ask yourself, we already know the interest rate in this question is also variable. So we have to make sure we include a column for interest rate. Whenever it changes, we need to keep track. After that, we go to the next element. We talk about the principal amount of the loan. And I believe this one now is very, very obvious to us. And after that, we ask ourselves, whenever you get some money, this person here, the loan that we are amortizing, there will be some additional repayment. We know that the installments that we normally repay on any loan has two elements, and I've not put that installment I'm talking about, which is very, which I believe, where does it fall? Now, the interest that we pay it as part of the installment. So members, installment should come before. Installment should come before the interest, because when you pay an installment on any amount of loan, part of it goes to pay interest, part of it goes to reduce the principal loan amount. And as you repay the principal loan amount, there is a lump sum repayment at some point. We read the additional information we're going to see. So we have to introduce this new column. We call it additional payment. This is not the usual column. This is not the usual format that we normally have. I believe you are noting the differences. Then obviously it must have an ending balance. This one is usual. So you realize that we have unusual additions. This column is not always applicable in all amortization schedules. Again, you normally don't have to bring interest rate column in an amortization schedule. Why? Because it is usually remaining constant. In this case, it will change. Then again, it is also not normal or not obvious to have additional loan column. Obviously, because we normally have these schedules where once you secure a loan, you repay it back in full is when you are given another one. But this variation, we have to take care of it in this question here. So allow me to highlight that, the titles. Then we start putting in the entries. I told you in an exam, please maximize on entries and make sure. Now, I believe you realize that we have to adjust our speed. The reason being, in an exam, speed matters. You might have the concept, but if you don't calculate and work with budget with your time well, you will lose marks, not because you don't know, but because time will cut you short. It will be very unfortunate and painful to lose marks where you knew and you had the concepts. Please try to train yourself on that. We've seen that the period for the loan is 120 months. So members, if it's 120 months, what do? I would want us to use the series functionality to list the months from month 1 to month number 120. And to use the series functionality, there are two approaches. Someone who doesn't like stress, someone who likes, not to complicate things, will just come here. And then, yes, it has to start from 1. I don't know why my font is coming to font number 16 whenever I type on this sheet. And I would want to make it uniform. How do I make it uniform? I highlight the area and reduce my font to 12 so that it be uniform. Simple formatting. Then, once you type 1 on the first cell, for someone who does not like to complicate things by putting in the Excel, the shortcut that we know, this person will just come here to the editing section on the home tab. And on the home tab, once you come here, you will see there is this box with an arrow showing downwards. You click on that drop down. And what do you pick on? The series. Once you pick on the series, there will be that pop-up window. Then you say, my step value. Step value means what interval? When I move from period 1, I should go to period 2 or I should jump some other periods. Interval should be 1 because we have to be progressive. 1, 2, 3 up to 120. Then I want somebody to tell us in this series, what alignment are we borrowing? Do we want to have the numbers appear in rows or in columns? Rows or columns? Elo is saying column. I will choose on column. Somebody else is saying something, column. Yes, I think all of us are agreeing that we choose on the column if you're using this series function, because if you choose a wrong alignment, then your figures or the period will appear in a different alignment. So we choose columns and we say we want to go up to 120. I say okay, and we have our periods. If you check with control down arrow, you'll see it is going to 120. Control up, you'll see it comes back to where we started. Simple, spreadsheet. Simple spreadsheet operations. All right, now we start our schedule. And someone is asking, where is this series thing? Oh, Liaka, what you do is simple. Once you are on your home tab, look at my window, your home tab window. Then I want you to look at the far right end of that window. Before you go to add-ins, there is editing section. Editing section where you have the formulas tab, where you have all this. I believe you can be able to see my screen and you are seeing the area where my cursor is hovering about. This area, I want you to choose on this button, or there is this, there is this fill. You see the fill tab, the fill with a down showing arrow. Click on that and you will see series. Series is appearing there. Series is appearing there. That's what you click on and the pop-up window comes up. Then you put it, you key in whatever range and where to stop and the interval that you need. All right. So I believe, members, you're okay. It cannot be inactive. Sherry, it cannot be inactive. It cannot be inactive. And if it is inactive, there is this other shortcut that you may use. Let me try. Can I remember it? Let me type 1. It is usually, is it Alt H F, Alt HFI, Alt HFIS, like that. Try that shortcut. You click on Alt H F I S. Yes, you can see that it's coming. That is a shortcut. If you are not seeing the series tab, you could use that shortcut. Alt H F I S. Alt H F I S. That is, you click on them simultaneously. you'll see the pop-up window. That's a shortcut you can use to maneuver that and get your series function working. All right. All right. So members, let's start. Look at the balance brought down part. Now, balance brought down part there is also usually not appearing in our usual statements, but here it is because of the obvious reasons. We know there are adjustments that are happening across the board. So I would want us to look at the balance brought down. Balance brought down here, we ask ourselves, we are starting period one. We are starting period one, and Winnie is still at the alt. Winnie, I said alt H. Alt H F I S. I've said alt. Let me just type it so that alt, then you click on H, then you click on F, then you click on I, then you click on S. You'll see a pop-up. So just click on this tab simultaneously. Start with alt, then go to H, F, I, S. You'll see a pop-up window for the series function. You'll see it coming up. You will see it coming up. Alt H F I S. You'll see it coming up. All right. I believe it's okay now. I believe it's okay now. So this shortcut will help you to fill up a range of numbers without having to type. Imagine when you are typing 1 up to 120, you would say 1, you go to 2, you go to 3, 4. Look at that. It's a lot of work. I mean, with this Excel knowledge, it will be very unfortunate to see someone doing that. That is a total waste of time. So please avoid it. That's why I also told you that if you are working across a very wide sheet, then also you have to use the shortcuts. For example, you are in number 1. If you want to go to the last page, do you start scrolling? What if there were 1,000 rows? You're wasting time. Use the control down arrow. Yes, or the page down. And again, use control up arrow or page up or home. So those shortcuts are normally useful in maneuvering these sheets, and it saves you time. All right, now what is the balance brought down for period 1? Balance brought down for period 1 is the amount of the loan that we are starting with. And I believe, members, we are all agreeing that the balance brought down, or the amount of loan opening in this period 1, is that the total amount, that is 5.7 million, 5.7 million there. Then we go to the additional loan amount for period 1 when they started. Was there any additional loan? We look at additional information number 1, where we were told an additional amount of 550 is repaid with the 20th installment. But before we start looking at this period, I would want us to remind ourselves of certain functionalities which I believe you've been using. And I just want to mention them. I know that you're already aware of these functionalities. Now, when we talk about computation of installment, of a loan installment that is to be paid, we know the functionality that we use to compute the installment to pay. The installment to pay, we normally use the PMT function to get the installment. And I believe, members, we know that. Thank you, Oppo. Oppo is telling us PMT. Then we also know that in our schedule, apart from the installment, we have to get the interest. Now, there are 2 approaches in computing the interest rate to repay on that loan. You could go the manual way, which is usually, obviously it's very easy and advisable. Why is it easy and advisable? Because it is simply the interest rate multiplied by the opening loan balance. Interest rate, you multiply by the opening loan balance. That will give you the installment. That will give you the interest. That will give you the interest to repay. Yes? The opening loan amount by the interest rate. Or if someone wants to use an Excel function to get the interest rate, apart from taking the rate of interest, the interest that is to be paid, did I write the interest or the interest rate alone? This is the interest rate. Interest rate, there is an opening balance. Let me see. There is something I skipped here. After opening balance, I ought to have brought interest rate here first before we go, because we use it to compute these other installments. So let me see. Let me just introduce a column. And I believe someone knows this shortcut I'm using to either delete a column or a row and add or, the column, add or delete a column. I've just added a column here. And the shortcuts there are very simple and they help you to maneuver through, and I believe you know them. Now, interest rate there, then we have installment, then here now should be the interest, right? And this is the interest that I'm talking about. Now, interest there, I've just said, you are using the manual approach is very simple, where you take the rate of interest, you multiply by the opening loan balance, you get your interest to be repaid. Then, because we know installment has these two elements, the difference between installment and interest gets you the principal. I believe we know that. Now, for someone who does not want to use the manual way, you can still get your interest using an Excel function. And the Excel function you can use to get your interest is called the IPMT. The IPMT. Yes, it also gives you the same interest that you get when you use the manual approach, the direct approach. Then again, the other functionality that you can also employ. I've just told you that installment has two elements. Once you compute interest, the difference between installment and interest gives you the principal. That is obvious. But again, should someone ask you to use an Excel function, which Excel function gives you the principal? It is called the PPMT. We are reminding ourselves because these are not new concepts. So we can also get your principal by the difference between these two. You get your principal, or you can decide to use the PPMT function. You will still get the same principal amount. So members, these Excel functions, sometimes you'll get an examiner who wants you to use an Excel function to compute them. Remember that these functions gives you the same elements that we are going to get straight away. Now, let's do it practically. Additional loan amount is coming from additional information number 1, and it's coming as the 20th month with the 20th installment. So that does not affect our period 1. But so period 1, I will just type 0 or leave it blank. In fact, even typing 0 is not important. Let me just leave it blank because you don't have an additional loan. So opening balance of the loan in period 1, opening balance of the loan in period 1 should be the balance brought down of the loan plus any addition, So I will click on that column. So whenever there will be an addition, it will affect our opening balance. Remember, we are laying ground. We are setting formulas at this point. We are laying ground so that we will not repeat everything at any given stage. We'll only point out areas where things are changing. Members, I hope we are following. All right, Control Enter. And I believe you also know why I'm using Control Enter and not just Enter alone. Simple things, simple things which you need to remember because they will help you. Yes, Realme IPMT, thank you. We go to the interest rate. Now, members, we were told something about interest rate. Let's look at additional information number 2, not 2 there. We were told the rate of interest is adjusted to 13.8 per annum with effect from the end of the 4th year. At the end of 4th year, that means how many months have elapsed? At the end of 4th year, how many months shall have elapsed by that time?
48.
At the end of 4th year? 48, thank you. 48, thank you. I see the chat box there. Members are responding, and I've also had a member talking 48. Thank you. So at the end of the 4th year, the rate of interest is going to change. The rate of interest is going to change. So why don't we just straight away go ahead and fill in our interest rate? And I believe the interest rate is changing once. I'm not seeing any other time when it is changing. This is the change in the interest rate at the end of 4th year. These others did not mention anything to do with interest. So what do we do? Members, to save on time, let's come to the interest rate column. All of us in the interest rate column, let's look at it. The first interest rate that we've been given per annum was this amount of 12.5%, right? You see that was what was given in the question. So because we are doing our repayments on a monthly basis, we've agreed that for the rate of interest, if you want to get the per month rate, you divide by 12. So our rate is 12.5%. And because we are going to maintain the rate for the next 4 years, and to get a monthly rate, I told you we divide by 12, and that is the rate that we have. It is the same thing we had computed here, so there is no difference. The reason why you can either refer to this or you can still type it. It will still give you the same. And I don't like this many number of decimal places, but let me put it in percentage and increase the number of decimal places a bit like that. So that is the rate of interest at 12.5% per annum. This rate of interest goes all the way to month 48. So I'm dragging I did not want to autofill. If I could have double clicked, it would autofill to the month 120. But because it does not go to the end, allow me to just drag it to the 48th month like that. So at the end of 48th month, according to note number 2, we are being told that that rate of interest is going to change. Yes? And how do I know that it is at the end? I looked at the language of the examiner. The examiner said very well that the rate of interest is adjusted with effect from the end. From the end means it will go up to the end, but now from that end, meaning from month number 49, the rate of interest changes to 13.8% per annum. Now, members, we come here and now do that in practically here. Now, from the month number 49, our interest rate will be no longer 12.5. It will be 13.8%, 13.8%. And this is an annual rate. What do? Divide by 12 to get the monthly rate. And Control Enter, I have the monthly rate. And I will just introduce the percentage. And you see it is saying 1%, but there are decimal places. So I bring on board 2 decimal places like that. Now, because the rate does not change again from here, we just autofill. How do I autofill? I can have 2 approaches. Take it and pull it from by the tail to month 120, or I could simply double click and it will autofill to the end. Members, I believe we are okay up to that point. I believe we are good. So interest rate, we've already effected the changes that have happened. We look at the next thing. Now, the next things,
1.1.
is someone speaking?
Yes.
Yes.
I was
Go ahead.
saying, mine is 1%. Will that one bring a difference of the answer?
Your 1% is correct. You just need to increase the number of decimal places. If I remove mine, so you see mine is also 1%.
Okay.
Just increase the number of decimal places to 2 of them and it will appear 1.15. All right. So, members, we go to the next element, which is installment. And I believe we've just talked about installment using the PMT function. PMT is a payment function. A payment function will always come as an outflow approach because you are paying. Whenever you pay, it goes out. So a PMT function will always give you a negative figure. PMT function will always give you a negative figure. So whenever you're doing an amortization schedule, you want to work with positive figures, even though we know it's a payment. It's an installment you're paying. It's an interest you're paying. It's principal you're paying. Whenever you use these functions, it will always give you a negative figure. So what do? Come to the installment. Because you're using a PMT function, please start with a negative to cancel out the negative output. Yes, so you come and say PMT. And of course, we know how to pick the formula. You either use the tab or double click on the highlighted formula, the highlighted function that you want. And I believe you can also see when I type on the PMT, it will automatically bring you the cumulative IPMT. It will bring to you the IPMT, the ISPMT, the PPMT. We've talked about PPMT, we've talked about IPMT, and again, PMT. This other one, cumulative, and the ISPMT, leave those ones aside for now. We don't need them. So PMT, I will pick using my tab key. Then it is asking me interesting things there. It asks me about the rate. Now, when it asks me about the rate, because I'm also already aware that my interest rate is going to change at some point, I will not go to refer to this rate, because if I refer to this rate, I will have to lock it. But again, so long as I'm aware at what point it's going to change, I can still refer to it and lock it up to the point it will change. But for consistency, if I want to refer and lock, then I will have to also type the other one that has changed in another cell and refer and lock. I don't want to do that. Why? Because we have introduced a column for interest rate. Members, I hope we are following. So what do? You see this rate here. I will refer to the interest rate aligning to that month. Aligning to that month. How much is it? 1.04%. Refer to it. Do not lock anything. Why are we not locking? We have each and every month's rate. So we don't have to lock. We will want to autofill these formulas. When we autofill, it will already pick the rate that we have there. So I will just refer, then put a comma. The next highlighted function we need to key in is the NPER. NPER simply means number of period number of period, and the number of period part is asking you, how long will you need to repay back this loan? That is what it means. The number of periods to repay back. I believe, members, we all agree that this loan is going for 120 months. Now, I can as well still refer to this period in months that we wrote there 120. But because we know that the periods are going to change at some point, you've seen all the additional information having issues with the periods and the rates and all that. Now, to make my work simple, no one will even penalize me if I just type 120 and not refer to any 120 somewhere. Because if I refer, I will have to lock. Members, I believe you understand. If I refer to this cell, I will have to lock when I want to autofill. But I'm avoiding locking by typing it here because I know it will be affected at some point. All right. In the usual amortization schedules, we normally refer because the rates are always constant, the installment are always constant, the period is always constant, but not in this our case. So after doing that, put a comma, then the next highlighted entry we are required to put is the PV. PV means the present value. PV means the present value, and the present value at that point is the opening loan balance for the period. Please do not refer to the original loan amount at this point. Do not refer to the balance brought down of the loan at this point. Refer to the opening loan balance for that particular period. And I'm referring to this here. The opening loan balance of that period 1. Then I will simply close the bracket. And whenever you're working with Excel functions, even if you don't close that bracket, Excel will do it for you. So you don't have to stress yourself closing. So even if I don't close and I click on my Control Enter, it will give me an output. All right. I know someone is already asking, how did you get the Kenya shillings appearing there? How did you get Kenya shillings appearing there? You can also get it where? On your home tab, there is this section where you have the formatting section. There is currency. You could go as well and pick on your currency that you need. Pick on the currency that you need. And so that one should not really worry anybody. I will go and pick on currency. You see, mine is in Kenya shillings. I could as well do away with any currency because is it important? The answer is no. So I will click OK and you see it goes away. All right, we go to the next bit, which is interest. I told you there are two approaches. Interest, you could do it manually, which I would prefer in this case. Why? Because you should clearly see the impact of the change in interest rate on the rate. Or as well, you could use IPMT function, works perfectly well. And I would just want to go with the simple one, We are not here to complicate things, members. We're here to work with the simple ones because the goal is to get the scores and you go home. Now, under interest. Yes, Winnie. Yes.
My figure is different with yours. I don't know why. Because you're getting 83, I'm getting 384, 344.16.
If we have the same opening loan amount and we have the same interest rate, your figure cannot be different. We are using the same Excel function, the same opening loan balance, the same interest rate. So unless there is somewhere or you are the kid in a wrong period here. If you have everything the same, there is no way you'll get a different output. There is no way, Winnie. Make sure, do you have the opening loan amount of 5.7 million, not 570,000, not 570,000. Good.
I see.
Good. That is very good. So I believe, members, we're okay. We move to the next element, that is the interest. And I told you, manual simple approach will come in here handy. And I said, and I still repeat, under the interest, pick the interest rate, multiply by the opening loan balance. Do not refer to the original loan amount or the balance brought downs. I put an equal sign and I refer to our rate. Our sheet is very simple because we have a rate column. So you don't have to refer to any rate written somewhere and locking it. No. Pick on the interest rate. What you do, multiply by the opening loan balance. And I'm doing reference. I'm not typing. We can see the opening loan balance is 5.7 million. But I'm not typing it. I'm referring to the cell under the opening balance column. Control Enter gives me the interest that we are repaying for period 1. After that, we go to the principal. I gave you two approaches that you can use the PPMT function, which complicates it for no reason. Unless someone asks you to use an Excel function to get the principal, please use the PPMT. But if no one is interested in whatever you use to get it, please come here and choose the simple. What is the simple one? equal sign, installment minus interest, you have an output there. Very simple. Now, there was something about additional payment. Does it affect period 1? Look at note 1. It was coming with the 20th installment. So period 1 has no additional payment. But when it will come in that 20th installment, we need to set a formula to capture it. We need to set a formula. We need to set a formula. Right? Admin is asking. The question asks use Excel functions. Thank you, admin. And I would want us to look at the required. Look at the required. Using MS Excel. Using MS Excel. Assist Joanne to prepare the entire duration of the schedule. Factor in the information provided above. And I want admin to look at that. Using what? MS Excel. MS Excel. Excel is the entire tool we are using here. It did not specify that in your computation of interest, make sure you use IPMT or use an Excel function. In your computation of principal, make sure you use the PPMT or the Excel function appropriate for that. It just told us use MS Excel. Admin, I hope you are well guided there. All right. We are under additional payment and we've agreed it will come in with the 20th installment, meaning our additional payment here is blank or 0. I will not type 0, leave it blank because I don't have a reason to type 0 anyway. Ending balance, we know what ending balance means. We are talking about ending balance of the loan. Interest is not part of the loan. Interest is the cost of borrowing. Now, under ending balance, put an equal sign. Pick on the opening balance of the loan. The loan amount was 5.7 million. Now, to get the closing balance of the loan, we will take off the principal you are paying. Do not pick on installment. Installment has both interest and principal. Do not pick on interest because interest is not the loan amount. Interest is just the cost you are paying on using someone else's money. So it does not reduce your loan amount. If you have a loan and you ask for a statement and you get that loan statement, do not start quarreling about the ending balance, saying that, but I've been paying 80,000 every month. How come my loan amount is not reducing? Remember, you've been paying some cost called interest. Interest do not affect or reduce your loan amount. So before you start quarreling and, throwing tantrums at people, either in a circle or elsewhere, I've seen people are fond of this thing. I've really witnessed it. Someone is saying, no. I've been paying my loan. How come it is not reducing? It is just going up. No. Remember, the amount you pay has interest, the cost. But the balance, interest does not have any role to play. Now, pick on the opening balance, take off your principal, and then remember, in case there is an additional payment, we've been told it comes with the 20th installment, please take it off. So I'm setting a formula, so I will take it off by just referring to this blank space. When we reach the 20th month where there will be an additional, then it will be taken care of accordingly. Control Enter gives us the closing balance for period 1. I'm seeing some chart here. All right, you see someone is still at period 48. Interesting. Somebody please respond to the member there as we continue. All right.
Kindly
So,
repeat the ending balance.
Sorry?
Repeat the ending balance. I'm getting a different answer.
Ending balance is the opening minus principal minus additional payment. That is how you're getting the ending balance. So if you have the correct opening balance, like the one showing, then you have the correct principal. You should have the same ending balance. So just check out these are your prior figures. Check your prior figures because there could be a difference here. There could be a difference. Check them, please. Check them, please. Make sure this is 5.7 million, not 570,000. So let me put a comma style to make it be visible clearly.
I've seen it.
Thank you.
Now.
All right. Now, we are in period number 2. And remember, whenever you're setting Excel formulas, do not start dragging from period 1. It is good practice that you set your formulas, you take off from period 2. Take off from period 2. You don't take off from period 1. Yes, take off from period 2. That's when you can autofill whatever you want to autofill. So in period 2, the opening balance in period 2 or the balance brought down for period 2 will be the balance carried down for period 1. That concept, I believe you can relate to it. We've done several of it. So I will refer to balance brought down for period 2 and I refer to the carried down of period 1. Carried down of period 1 is the ending balance for period 1. And make sure you refer, do not type. We are setting formula, we want to autofill. Refer to it, then bring it there. Then, additional loan amount. I want us now to come to additional loan amount. When is the additional loan amount coming in? So that we know when it is coming in. And I believe it is not in period 2, it will come in later. But here we are setting a formula and we are going to bring it on board. Now, we go to the opening balance. I had set a formula for opening balance. It should include additional if there is. And even if we will realize there will be additional for period 1, maybe we forgot to put it. Once you put it here, it will take effect because we had already put in as a formula. All right, now, that formula that we had put in for opening balance, members, there will be no harm if we repeat the same formula here. So I've just dragged it once. That is the formula. You see it as picked. Very nice. Our interest column is all taken care of to the end. We come to installment. We had also used a formula for installment. This formula is not going to change anytime soon. That formula is remaining constant until the number of period or the period changes. So it will always pick the periods. Remember, we typed in a period. Do you see the period we typed in? We typed it in. Unless there is a change here, this installment remains constant. For now, we just fill it like that. We go to the interest, check on the formula we used. It was rate times the opening balance. That also remains the same. So up to period 2. Then the principal, we also got just the difference, but someone could use the PPMT. You still have the same output. Additional payment is not coming anytime now. It will be coming later. Closing balance formula, we already put it there. And that will also remain the same. Now, up to this point, members, I would want us to look at the additional information to guide us up to what point are we autofilling each and every element. We want to autofill, but whenever I autofill by either tapping or dragging, and because we're using a wide range of period, if we double tap, it will autofill to the end. I don't want it to go to the end because there are conditions within the schedule. What are the conditions? Let's all look at the conditions and now take care of them as we move. And now this is the stage I want you to be very careful. This is where the difference between the others that you've done and this one comes in. Now, note 1 is saying an additional amount of 550 is repaid with the 20th installment. With. The language is with. The installment remains. You see the installment that we have completed here. This installment will remain. But on top of that installment, there is an additional payment that will come. Now, that payment is coming at what point? At the 20th installment. That is the 20th month. The 20th month. So let's go to the 20th month. Month number 20 is here. This is where we are doing the first change. The first change is coming at this point, at 20th month, like that. So I will even highlight it on a different color so that it is visible. So at the 20th month, we have an additional payment. So under additional payment column, why don't we put in that amount? What amount was it? Let me look at it. 550,000. Very good. So why don't we put there 550,000? That is the additional amount that is coming in by the 20th month. It's coming with the installment on that period. So when we will be dragging our formula, when it reaches here, you'll see the effect of that, the impact of that. Additional information number 2, what does it say? It says, no, 1, there is something we've not finished reading, is repaid with the 20th installment and the monthly installment recomputed. We have to recompute the installment after the month number 20. Why are we recomputing the installment? Remember, installment is computed using the PMT function. PMT function that we use to get this installment, I want to just activate it. You see, whenever there is an additional payment on top of the principal or on top of the installment, you are paying an extra amount, meaning your loan balance is affected. It will reduce your loan balance. And in computation of the installment, the PMT function, that loan amount, we referred to it. Remember, we started with the rate, we went to the number of period, then present value, the PV is the present value, the opening balance of the loan. Whenever there will be an additional repayment on the 20th month, that will affect the opening loan amount. So that's why they're telling us that we have to recompute the installment thereof because of that change. We have to recompute the installment thereof because of that change. These are the part that the examiner said. So why don't we go to month number 20? Then we start effecting this change. Meaning what? Meaning from month 2 to month number 19 or to month 20, there is nothing that is changing. So what do? I will pick, because I've set the formula. You see this balance brought down? I don't want to double tap because it will go to the end. I will just have to drag it to where I want it to stop. I want it to stop at month number 20, like that. I'm just filling the formula. There will be no figures, but the formula. The formula comes to that point. Then we go again to opening balance. There was a formula we had set. We also drag it to month number 20 because that is where we are doing our first change. So let it just come to month 20 like that. Manually, we are pulling it manually. If you double tap, you will see it will autofill to the end. We don't want it to go to the end because we have to take care of the changes at each stage. Now, installment, we are told to recompute it as from month 20 now because of that change. So from month 2 or month 1 all the way to month number 20, it will remain constant. Now from here, it is going to change. And I believe we are going to do it together and you see how the change comes. Interest, computation formula remains the same. So we also pull it to month 20 because nothing changes from now up to that time. Principal, that formula we had set. So we also pull it to that. And instead of doing the pullings one by one, someone is asking, we are using Excel shortcuts. Why do we have to pull them one by one? I was just explaining for each stage, but you don't have to do each of them at once. You could highlight them, the whole row that you want to pull. Then you pick on this tail at the end of the highlighted area. Then what you do, you drag it to the end because you already have formulas. So when you do that to month number 20, it will bring on board everything. Yes, it will bring on board everything. And when you do that, I want to check if that formula has come. You see there is no formula here because that's why sometimes when doing the schedule, you'll have to make sure that your formulas, all of them come. And this ending balance formula, you cannot pick it together with the rest at the same time. So I will just undo that. And then we could do all these others all together, but not with the ending balance because the ending balance will affect the opening of the next period. So ending balance now, we bring it on its own. Remember, it depends on the other columns. So we bring it like that and you see it now takes effect. And someone is saying something. All right, check note 2. Someone is saying that there is something in note 2 that we need to see. Let me see note 2. The rate of interest, we've already taken care of this. This one, we are done with this one. This one, we are completely done. We're just looking at this additional loan amount in note 1 at the 20th installment. Now, I've already typed or we've already put in the loan amount, and I think it went with the first autofilling, which I did. But it was 550,000. It came with the 20th installment according to note 1. Now, let's look at the impact of our formula that we had put in here. Let me activate it. And you will see that the closing balance of the loan for that period 20 now also reduces further. Besides reducing the principal by this usual installment, it also reduces it further by the additional repayment done. So our closing loan amount is even lower. Without the 550, it could have been higher than 4.6, but it is at 4.6 because we have reduced it further. And that's why we have to recompute installment from that stage. Now, the installment we are recomputing is now being effected from month 21. Now, the opening balance for month 21, the formula remains the same. It is the closing of month 20. I hope you are seeing that. Then, when we come to the opening loan amount, that opening loan amount, again, our formula will still remain the same because it considers additional loan. There is still no additional loan. So that formula at month 21 will still be the same. So what do? I just drag that formula there. We are reflecting the change. And I want you to see where the change is coming. Then someone is saying our installments are changing. Someone is saying our installments are changing. And of course, I can see that it has changed. Let me see. All right. Very nice. This is interesting. Now, does someone know why our installments have changed? There is something that we did not do when we were computing installment at stage 2. Do someone know why our installment is changing? Somebody tell us. Does someone know why our installment keeps changing, yet it was supposed to be constant? There is no element. You know, the major elements of installment are the rate, number of period, present value. Present value is the current loan that we are servicing. Yes, and the rate has not changed. The rate only changes at the 48th month. So somebody should just remind us, there is a concept we forgot. Locking, thank you. We did not lock. What did we not lock? We did not lock the loan amount that we are computing. The installment on. The loan we are servicing is still 5.7 million. So what do? I want us to go back to note 2, to period 2, then we lock the loan amount. You see, and the loan amount, you see, even the one in period 2 is wrong. The loan that we were servicing is 5.7 million. So we need to refer to the correct loan amount. The correct loan amount is 5.7. That is the loan we are servicing. So that 5.7 million still remains constant. It has not changed up to this point. So we'll fully lock it by using my F4 key. Or if your F4 is not working, use function F4. Now, Control Enter. Now, once I do that, you will see that things have changed, yes, but then we need to autofill this formula to period number 20. Period number 20, like that. Period number 20. Yes, because the rate of interest still remains constant. The rate of interest still remains constant. So once I do that, remember this other one was referring to this loan amount, which is wrong. This other one also. So you see, all of them were referring to their own opening balances, which is not the case. We need to make sure that our loan reference, the loan we are servicing, is the same loan amount. And that means our installments are supposed to be the same like now they are, up to month number 20. Yes, because we've not been told if something has changed. We've not been told if something has changed like that. Now, once we reach there, at month 20, once we reach at month 20, now we look at that change that is going to happen. We recompute the installment at month 21. Now, how do we recompute the installment at month 21? Interest rate we have. Now, let's come to installment using the PMT function. I pick it. The rate of interest, we just refer to this interest here. I put a comma. Now, somebody tell me, what period am I going to use in this my new PMT? What period am I going to use? Remember, the period we were using was 120, right? What period am I using here? Somebody saying 100 there. 100 also, Frida. Thank you. And I will agree with those two fellows, because I believe all of us understand where the 100 is coming from. If the total period was 120, we've already covered the 20 months. We are recomputing our installment after the 20th month. So 120 minus 20, the period we're remaining with is 100 months. Members, I believe we understand. So this period that we are coming with here, number of period now is 100, not 120. We already passed the 20th month. Then after that, I put a comma and it's asking me about the present value. Now, the present value that we are picking at this point, is the current opening balance of the loan. And the current opening balance of the loan has been reduced further by the 550. So that's why we are recomputing it. Remember, the one we were computing was referring to the original loan amount. So this is now our loan amount we are starting with this period. That is the change. So after that, Control Enter gives me the current installment that we are going to pay moving forward from this date. And yes, it is coming with a currency, but we don't need the currency. So I would go and do away with the currency. Say I didn't need the currency, like that. Then, now this installment, unless it changes, this installment, unless there is something that will change, this installment will remain constant. So we go ahead to the next element, which is interest. Computation of interest remains the same. That formula does not change. So I will just autofill that to that date. Then the principal also, the formula remains. Then the closing balance, it will still pick the same formula. And we have up to the end of period 21. Now, what is the next question? What is the next question? We should lock. Thank you, Mika. You've reminded us. The same problem that we had from period 2. If you do not lock this loan amount you are working with at this point, it will still pick on the others. It will still give you different installments. So we need to lock that. Thank you for that very good reminder there. That means we are following, and that means we are understanding this concept. Very nice. So I will make sure you lock that, because we would want to autofill after this. And I'm seeing somebody saying, have locked. Thank you. Yeah, someone speaking?
Oh, please, this in your principle, I'm getting a negative of 122 and everything is the same.
Because you are using a PMT function and you forgot to bring a negative. Yes. When you are using the PMT function, I said PMT means payment. Make sure you bring negative. If you don't bring it, it will give you a negative figure. So make sure you do that, because we're working with positives. Right. So we are starting from period 21, and I want us to look at any other note so that we know up to what point are we autofilling. Let's look at note number 3. Note 1 and 2, we are done. Note 3. Note 3. We are told the monthly repayment is recomputed. That is, note 3 follows note 2. Note 2 is where we did our interest rate change, yes? And we know that when the interest changes, it will affect a lot of other things. And that's why note 3, they are starting by saying the monthly repayment is recomputed. That is at the end of the 4th year, which is given in note 2. When the rate changes, we have to recompute the repayment to fully repay back the loan. And I want you to look at the language here. The monthly repayment is recomputed to fully pay the loan balance in 12 months less. So why don't we go up to the 4th year? Because this note 3 picks it from 4th year. You see, when we are changing the interest rate, that is at the 4th year, and I believe we agreed that that was the 48th month. Where is 48th month? At this point, this is where the change happened. You see that? That is when, after this date, is when our interest rate changed. So I would also highlight that row there. That is when the interest rate changed. So from month 21 to this date, the interest rate is constant. Yes, and we've not been told if there is any additional loan between this period up to month 48. So there is no major difference or no major change that we need to effect. So why don't we autofill these formulas we have set up to month 48? Then now we go to note 3 and start effecting what the examiner is saying at that point. We go and effect it there. Yes, somebody is saying, Faith is saying, Mwalimu, after we change the PMT for the first 20 months, we should have dragged the formulas again, because from my end, I have a different closing balance. But we are still at the 20th. We've just gone to 21st. You've gone ahead. You are already ahead of us. We are still here. This is where we are still picking it from month 21. And the opening of month 21, remember, the brought down of month 21 is the closing of month 20. So that formula there remains the same. What has changed are these other elements from the installment computation. And we've locked our loan that we are referencing to at this point. So let's go to month 48, and I will pick my balance brought down column and pull it. I want to pull it up to month 48 like that. Those formulas are already there. We go and pull the same on the balance brought down. We had set the balance brought down. That formula remains the same. So I will pull it again to month number 48 like that. That's where the next change is going to happen. Then we go to our installment that we have recomputed. So it is the new installment that we are pulling to month 48. So I will also do the same to month 48. You see the installment is constant. Yes, because our loan amount has not changed or will not change within this period until we go to that other period. Then now these are the formulas of interest and the principal. Those formulas are also going to remain the same. So we'll also pull them to month 48 like that. And because I pulled them together, I can pull these ones together because it's okay. They do not depend on each other. Yes, they do, but it will not affect the autofilling of the formula. I know someone is wondering, why is my interest here blank? It is blank because it depends on this balance. And this balance depends on the closing of the previous period. So that is still okay. We go and now pull the final. Do not always pull this final column with the rest. It will always mess you up. So make sure you bring it on board on its own. It depends on the other. So if you pull it before or together, it will mess you up. Now, we are at month 48. And this is where there is something else that is going to happen. And I want us to look at month 48 and see, read note 3 and see what is going to happen at that point. Now, note 3, let's all go there to note 3 and see what the examiner said. Now, note 3, the monthly repayment is recomputed to fully. Where is the repayment being talked about here? The monthly repayment is the installment. You see the installment here? This is what we are recomputing. I can even highlight it in red. This is what we are recomputing, the monthly repayment. We have to recompute this. That's what the examiner is telling us. How do we recompute it? We are being told the monthly repayment is recomputed to fully pay the loan balance in 12 months less than the initially agreed period. 12 months less. What was the initially agreed period? We were to pay the loan in 120 months. In 120 months. That was the initial agreement. But now the examiner is changing tune and telling us, now, don't worry about the initially agreed. Please, that initially agreed, work with 20 months less, with 12 months less. Work with 12 months less. So who are we to argue with the examiner? We just follow what the examiner is telling us. So, because you don't want to argue with this with the examiner, we just come and now follow what the examiner is saying. Now, let's put it where we need it. We need it from month 49. The examiner is saying, we recompute our repayment, but we make sure that we are recomputing it so that we repay the loan in 12 months less. Now, members, the original, let me just put it here. The original period to repay the loan was 120. Yes? Then, at what month are we? We are in month 49. What period have we already covered? We've covered 48 months already. We are recomputing the repayments from here now. From what month? From month 49. We've already covered 48 months. So what do? We less 48. We are recomputing from month 49. We less 48. Then what do? We go and now follow what the examiner said. The examiner said, we make sure we recompute, but make sure we are repaying this loan in 12 months less. So what do? Again, deduct 12. Like that. So when you deduct 12, what period are we now having that we are going to use in our PMT function? What period are we having? So I will come here and now put the formula. 120 minus 48 months we've already covered, minus 12 that we are being told we are repaying in 12 months less. What period are we having? 60 months. So we come to that month 49 and put our PMT function, we pick it and we now look at the rate. Has the rate changed? The rate has changed, yes, it is now 1.15. We already did that. We already set the rate. So we just refer to the new rate like that. We are not locking because every row, every period has its rate. So we needed to lock anything. Put a comma. Number of periods is what we've computed here. Now it is 60. Now it is 60. I will type the 60 there. Put a comma. Present value. Someone will ask, what loan are we servicing? The present value of the loan has not changed. Remember, the loan only changes when the principal is affected. The principal loan amount was affected once at month 20. So the loan amount we are still referring to is the new loan amount after it was affected by the 550. And the loan amount still remains the one that opened period 21. That is the loan amount we are servicing. So make sure you refer to it. And that loan amount has not changed. So we have to make sure we fully lock that loan amount because it is important. Until it changes, until the principal loan is affected, we will retain that loan amount. Then what do? There is nothing else to put. In an Excel function, anything given in parentheses is not compulsory. So this FV, the future value, and the type, those ones we don't need to worry about them. I don't even also need to close that bracket. Control Enter. I have my new installment. It is coming with currency. That also should not worry us. We don't need that currency. I will remove it. The highlighting in red, I'm the one who put it there because that was a critical change that was to happen. Members, I hope we are together. After we've recomputed the repayment at that point, now we again also recompute the interest and the principal. Of course, they will depend on this. So these ones, the formula is still there, and it is the same formula that we are going to use. This formula here does not change. So it's only going to pick on the new figure when we move up to that point. So what do? I will come here and check on the opening balance brought down for month 49. Yes?
My interest now is not coming 1.5, it's 115.
It is because you've done a wrong editing. So just remove the 115 and put 1.15%.
Okay.
Yes, the interest should be 1.15 because it is 13.8, the new rate, divided by 12. You should have that. So the balance brought down for month 49 is the carry down for month 48. And once I do that, you see this formula which I had brought in here now picks the balance brought down is there, adding the two like that. And now I also have the new interest rate and the new principal to repay. Those figures are there. Then the closing balance, obvious, the formula was already there. So the formula remains the same.
Excuse me, Mwalimu.
Yes?
The principle that you used, did you use the one in month 21 or 20th? I'm getting 123.
I said you are using the principle that opened the new period, month 21. That's when the loan amount changed. This is when the loan amount changed. Remember, the change was in month 20, at the end of month 20. That's when the change happened, at the end of month 20, meaning it only affects the loan amount from month 21. So that's why you refer to the opening balance of the loan in month 21, not month 20, please. Not month 20. All right.
Okay.
All right. Good. So from here, I would want us now to check on note number 4. When next are we expecting a change? Because we want to know up to what point are we dragging our formulas. To know that, let's go to note 4 and see. When are we expecting another change? Look at note 4. We are told in note 4 that the borrower enhances his monthly repayments by 18,000 per month. From what period? From the end of month 64. So members, let's look at month 64. Now from the end of month 64, now this person also will put in other additional payments. The same ones, the same way he did on month 20 is the same way this person is also intending to do from month 64. From month 64, he's intending to bring on board some other additional payments. So that is when the next change is happening. And remember, whenever there is an additional payment, and the examiner needs to guide us very well. I want you to look at the language here. The language given in note 3 and the one that is coming now in note 4. Look at note 3. Note 3, the examiner said, the monthly payment is recomputed. Meaning, we only do the recomputation when told. We did the recomputation after note 1 because we were told installment to be recomputed. Again, in note 3, they started by just saying the recomputation. The monthly repayment has to be recomputed. But in note 4, the examiner is not telling us to recompute. I hope you are understanding the language. The examiner is not telling us to recompute in month 64. He's not telling us to recompute. Then when you come to note 5, where there was an additional loan, the examiner told us again the monthly repayment is recomputed. So we only recompute when told by the examiner. We follow the instructions. So in note 4, we are not going to recompute the installment. Please, members, I hope you are getting it. But there is an additional repayment, meaning the principal loan amount is being affected here. And whenever the principal loan amount is being affected, it is obvious you need to make sure you revise the amount you're repaying because you are reducing your loan. You are reducing your loan. Why is it that I'm reducing my loan, but the amount I'm repaying remains constant? According to the terms of this person here, yes, the person is enhancing the repayment, but the amount that the person is intending to continue remitting remains the same. He is just enhancing. That is the language. I'm just enhancing my repayments. So you don't have to recompute the what I'm comfortable with what I'm repaying. So I'm just enhancing it. I'm just enhancing it. So we are not going to recompute, note 4. Members, I hope we are getting the language. Let's come to month number 64. So is it at the end or at the start? Let me look at the language again. The borrower enhances his monthly repayments by 18 per month from the end. So let's go to month number 64 with our formulas. So I will pick the formula from month 49 and take it to month 64 because the change is happening from the end. So up to the start like that, then I will pick again the balance brought down of the loan, the balance, opening balance, bring it to that point, the formulas. I'm bringing the formulas, members. Then you see the installment we have recomputed. The installment we have recomputed from month 49. The installment we have recomputed from month 49, that installment remains the same. We have, I hope we locked that loan amount. Yes, we did. So we are pulling it to month 64 like that. We are pulling it to month 64 like that. Then the highlighting looks very conspicuous. So allow me to just remove the red highlighting, the filling there. It's not necessary now. Then the formula for the interest also remains constant. So, and I would even just drag the two of them together. There is no problem. There is no harm up to month 64. Then, of course, the formula for closing balance remains the same. And this one, always make sure you drag it on its own because it depends on all the rest. If you drag them together, it will mess you up. Now, let's see now when the enhancement is done. At the end of month 64, and how much is the enhancement? They're enhancing it by 18 per month, 18,000 per month. The question is, for how many months are they doing? Is the person or the borrower doing the enhancement? 18,000. And whenever I put the 18,000 as the additional payment, you will see it affects the closing balance further because that column is reducing. Besides the principal repayment, it is reducing further by the 18. Now, for how long is the enhancement being done? They've just said enhancing by 18,000 per month. Did they specify the number of period? And how do we know the number of period? Elo is saying to month 69. How did you know month 69? I think it's because of additional information 5, where we're being told when the additional repayment is being done. So we will assume that the enhancement happens until the next loan comes in, the additional loan. This one you can also relate. For those who are members who have loans in SACCOs and banks, you can be told that if you need additional loan, because maybe you are stuck, you need some more money, you are being told, please, from now, you need to put in some amount so that your loan is reduced to a certain level, then we can add you another loan. And I believe that is the concept here. This member was enhancing this thing intentionally so that he can get the more loan that is coming in, and that is what is told in note 5. There is an additional loan amount. Yes? Yes? Someone is saying, why is installment higher, yet balance is reducing? Let me see the installment which is higher. Installment is the agreed remitted amounts per month. And remember, when we are computing installment, we are computing installment based on the current loan we are servicing. So the installment does not depend on this balance, opening balance of each period. Remember, the member who is asking, I didn't get the name. Who was that? Oppo. Make sure that the installment you're computing depends on the current loan you're servicing. Do not pick on each and every period's opening balance. I hope you are getting what I'm saying. So it does not depend on each period's opening balance. Installment is on the original loan amount. And if you have a loan, check on your loan statement and you'll realize that this concept is the same. Because you will be computing your installment on the opening balance and you'll say that, I've been paying a lot. No. Or my loan balance is not correct. No. It is on the current loan amount you're servicing. So make sure. So it does not depend on these changes here. I hope you are guided well. So let's do the changes. And we are told the loan amount is coming in at what month? The borrower is advanced an additional 700,000 at the end of month 70. At the end of month 70, meaning from this point when the change has happened in month 64, from month 65 to month number 70, nothing changes except the additional adjustments or the enhancements that has been done. So the enhancement comes up to month number. The enhancements will come up to month number 70. I saw a member saying month 69. It is not 69. The change happens at the end. The change happens at the end of month 70. Yes? Because we are being told that the additional loan comes at the end of month 70. So at the end of month 70 means it only affects from month 71. That's when the change takes effect. So I can now highlight this one because that is when the next change is going to take effect. So,
Excuse me, sir.
yes?
Does the 18,000 starts from month 64, month 65?
Look at the language the examiner said. The borrower enhances his monthly repayment by 18,000 per month from the end of month what? 64. So when are we doing the monthly repayment? We are doing the repayment at the end of the month. Yes? So we are starting from the end of month 64. Because that is when the payment is done. I hope you are understanding that. The payment is done at the end of the month. And that is when we are starting to give the 18,000. Yes? But additional loan is coming at the end of month 70, meaning the additional loan now affects month 71, not month 70. So we come to month 71 and put the loan amount. The additional loan amount is 700,000 at month 71. So from month 64, the formula for balance brought down remains the same to month 70. The balance brought down remains the same. The formula remains the same to month 70. Now, the installment. We have not been told in Note 4 to recompute the repayment. Yes? However much there is an enhancement, we have not been told to recompute this. So this remains constant. Please note that. This remains constant to month 70 because it is in Note 5 that we have to recompute the repayment. At this point, we are not recomputing. We are not told to recompute. The formula for interest and principal, I will pull them together. It comes up to month 70. Then, of course, the closing balance formula, now we bring it on board and it will take care of the 18,000 enhancement per month. So it will come all the way to month 70 like that. Now, at this point, we now effect the change. We have an additional loan. So meaning the amount we are paying has to change. That's why even the examiner is telling us we have now to recompute. And that's what Note 5 is saying, that the borrower is advanced 700, we've taken care of it. At the end of month 70, meaning the loan amount starting month 71 now is higher by 700,000. And again, the examiner is telling us, now the monthly repayment has to be recomputed. To fully pay the loan balance, I want to look at the language there, to recomputed to fully pay the loan amount or the loan balance in the period that had initially been agreed. Are you seeing the twists? In Note 3, we recomputed the repayment 12 months less than the initially agreed period. Now, the examiner is now going back again and telling us, no, now make sure that the balance is repaid in the initially agreed period. You see the twists? Now we come here and ask ourselves, we want to recompute the installment, but we refer to the initially agreed period, which was 120 months. Now we come and recompute our installment using the PMT function, equal negative PMT. I pick the formula. What is the rate? The rate we had already filled it in. The rate remains this one here, 1.15. That is the current rate. I put a comma. Number of period is now what we want us to look at. Number of period. What number of period are we now working with? Now, let's do the working here. The initially agreed period was 120 months. 120 months. In what month are we? We are in month 71. What period have we already covered? We have already covered 70 months. So we subtract 70 from 120. We are at month 71 now. 70 months is gone. 70 months is gone. 70 months is gone. Then, remember, we are having 120 months. So, between now and the end, how many more months do we have? 120 minus 70. So, that is the same thing there, minus 70. We have how many months to go? 50 months. So, the installment we are repaying here, we are now using the remaining period because we need to repay back in the initially agreed period. So, the number of period here is now 50. This balance here of the period remaining. Then the present value of the loan has now changed. It has changed by how much? 700,000 an additional loan. So we refer to this opening loan amount that will open this period after taking care of the 700. This cell here will have the opening loan amount, this one here. The opening loan amount is going to include the 700 now. And that is the current loan we are servicing. And the loan we are servicing is going to remain constant now to the end. There is no additional information again after note 5. So we fully lock that current loan amount because that is now what we are paying our installment on. And my figure will be 0 because I still don't have I've not dragged the formula for the opening loan balance. So let me drag the formula for balance brought down for opening loan balance. And now you'll see I'm having an installment. It is coming with a currency, but that should not worry us because currency we can remove and remain with that figure like that. Now, this is the current installment we are paying until the end. So this installment will remain constant. And make sure you fully lock the loan amount we are servicing now after taking care of the additional 700 like that. So this installment and the interest, the formulas remain the same. So I will just drag. The enhancement of 18,000 was meant to qualify this borrower for the 700. So we are not continuing with 18,000 moving forward because the objective has been achieved so that you win an additional loan. So 18,000 stops there. But the formula for the closing, we have to drag it so that it comes there. So there is no additional loan or enhancement at month 71. So from there, we can now autofill our formula to the end of the period. So we start with the balance brought down for that period. So balance brought down, I will just now double tap because I want it to go to the end, which is month 120. Then the balance brought down also I double tap to go to the end of the period. That is the end of our adjustments. Then the installment, because we've locked the loan we are servicing, it should also go the same way to the end. It is not going to change. The interest rate also we had filled into the end. Yes, it is highlighted, but I can as well do away with the highlighting because we've now understood how the change has happened. The interest and the principal amounts, it will remain, the formulas remain the same to the end like that. When we come to the closing balance of the loan, now this one also goes to the end. And we need to see that at the end of the 120 months, our loan should be fully repaid. If it is not fully repaid, then we did a mistake somewhere which we have to check. I still don't know whether it will balance. We need to check the end closing period and see, does it balance? The answer is yes. Our loan balance at the end is 0. We fully repaid back the loan. And this is what the examiner wanted. That is the end of note 5. Is there any other information we're leaving out? The answer is no. The required was prepare an entire duration. And the entire duration means the loan is being fully repaid back at the end of now, the 120 months. Members, I hope we are together and we've seen up to the end. I hope we are together. I hope we are together. And that is what the examiner wanted us to do. Yes.